Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking about something very, very important for all the money managers and other folks who provide money management services. Today we're talking about how due diligence has changed and a couple of things that have really impacted it, including AI and other macro changes. So today we're talking with Tim Pollen, CFA, who is a Senior Vice President, Investment Research and Product Management for Touchstone Investments. Tim and his team are responsible for identifying, engaging, and monitoring the investment advisors that sub-advise their current and future Touchstone mutual funds. So this is going to be right on the cusp of it. Um, Prior to joining Touchstone in 2010, Tim was at Klein Decisions, RBC Wealth Management, and Merrill. He got his MBA from Georgia State University, has a bachelor's in finance from the University of Georgia, and as I said already, has CFA charter. So, Tim, thanks for coming back to the podcast.
Yeah, happy to go with you again, Rob, and Happy New Year to you.
Yeah, you too. So first, let's talk about the process that the word some people have heard is the mosaic process around due diligence, because that's one thing that's been impacted by some of the things I mentioned already. So, what are your thoughts on how that's moving right now?
Yeah, I'd probably start, Rob, by level setting, because all of us in due diligence apply a process that's some semblance of parent, people, philosophy, process, performance, 4 or 5 Ps. We call our overarching process SPIDER, and that's another acronym. We're great at acronyms in this business. That's for stability, people, investment discipline, infrastructure, and results. I won't go into detail on all of those, but I will say that as I grew up in this business conducting due diligence, I know there's a rule to this day, to some degree, on simple screening mechanisms. But of course, sometimes eliminate excellent candidates based on narrow failure of a single stringent criteria. And to avoid such issues, ourselves and others that in the business attempt to surface relevant data and insight across multiple aspects without necessarily screening really tightly on all of the characteristics. And then once we surface that data, we can analyze and appreciate candidates more holistically across a lot of different features and characteristics of those firms and strategies. So just to illustrate, in my mind, a simple example of the downside of stringent criteria and screening. If we consistently apply a simplistic screen, let's say for alpha, north of some integer, 100 basis points,
Right.
we'd be ignoring important variables in my mind, like, what alpha is even possible in this asset class
Right.
or during a particular period of time. Further, if we only look at trailing periods, let's say through 12/31 of 23, we may eliminate managers who have consistently delivered alpha more regularly than the vast majority of candidates that we have at hand. So the mosaic is not only about looking across a number of qualitative and quantitative characteristics, but it's also looking across as many time periods in our minds as we can. And last time we talked, as you referenced, we discussed the challenges of measuring skill, but also the simple ways that we as investors can improve upon conventional approaches to skill measurement. And part of the mosaic from a performance measurement standpoint is to surface various statistics over time, whether they be absolute, risk adjusted, peer relative, benchmark relative, so we can evaluate consistency and also understand the types of environments when a strategy will struggle and when we should expect it to succeed. In our minds, there's really no such thing as an all-weather strategy. And so we have to prepare ourselves, through this mosaic approach to weather adversity and not abandon ship for the wrong reasons.
Yeah, I mean, this is something that I think is very important for the people listening to this podcast to understand, is that the whole process of due diligence is easy to nuance and is important to nuance. I think that this can be helpful in thinking about one thing if you want to help people like Tim out, clarity of your data. So that is exceptionally important in giving him the ability to use the mosaic. Do think about that. Now, one thing that has been out of favor for a while, that everyone knows about is EM and frontiers. And so perhaps we could use those as as a framework of talking about the mosaic process, but also looking at the challenges and opportunities that are presented by it despite its relative underperformance.
Yeah, I would say that, like a lot of other things with investing, what our recent experience has a big impact on how we think about a particular asset class. In this case, with emerging market equities, which I think you're focused more than on the debt side of the equation. We have a lot of investors that are questioning their commitment to EM equities, given the course of not just the past couple of years, but the past, say, 15 years of looking back at what kind of returns that have been coming from that space, particularly in an environment where the returns to U.S. equities have dominated just about any other category, large cap U.S. equities. Those that have remained invested in emerging markets have begun to think about the proportional exposures they have to different countries. And particularly, we're seeing a lot of product development in the kind of ex-China world, and a lot of demand for strategies that exclude China. And that could be for a variety of reasons. It could be a combination of political, social, and investment reasons that have led people to those kind of decisions. So there's part of me that sees this like any other backward-looking phenomenon. Investors often talk about buying things cheap or buying low and selling high, but it's really hard from an agency standpoint at times, to think about, well, what are the people that I serve, my stakeholders, thinking about having exposure to something like this when it hasn't done much for us lately? The non-investment element of the due diligence process, I think, with EM equities is also just naturally a bit scarier for investors because it's kind of removed from us. It's not something in our backyard that we're familiar with on a day-to-day basis. So questions like, what might happen post an outcome of a political race in Peru or Chile for my EM portfolio? What about my meetings with stakeholders after that when they start questioning me about why we had exposure to that country?
Yeah.
So I think it's normal we fear greater potential negative ramifications for investing places that are less familiar. And I think too often what happens is investors that remain committed to the space kind of go through the herd mentality of saying, I'm going to protect myself by being exposed to things that a lot of other people are exposed to. Well, so I can say, well, how can you blame me? And everybody else is doing it too.
Right.
So I'll go with the biggest fund. So to us, we see that as kind of a waste of effort. You got to maximize your potential in space. Don't sacrifice it by being too simplistic. And opportunity, and we've talked about that in our last, having an opportunity to deliver alpha is even more limited in emerging markets where liquidity can be much more challenging. So you have to keep your options open and your opportunity broad when it comes to looking at.
Yeah, I was thinking about this a little bit yesterday because we were here recording this podcast for listeners on January 10th. And the news last night was pretty eye-opening from Ecuador when a group of people with guns broke into the live evening newscast. And that's the kind of stuff that books into the back of investors' heads. And they think, wait a second, do we have any investments in Ecuador? Please let it be bonds. Please let it be bonds.
And if we don't have exposure to Ecuador directly, do we have exposure indirectly through other Latin American exposures and things like that? So
yeah, that's that makes it difficult. The other thing that is making things, let's say, more interesting in the investment world is the trend toward digitization, and that's had an impact on many, many things. But one thing I was particularly interested in talking about with you is the impact on research and investing. And so how do you think that impacts not only the general business of investing, but the due diligence process that you use?
Yeah, I think it's worth broadening it out just to think about how much technology has evolved since you and I got into the business. And, I started in the mid 80s and, there was no internet and, it was really inefficient to be able to try to find experts or try to find research, at your fingertips. So I broaden out to think about how technology has levered investment processes over the past several decades, because right now we're all reading about and contemplating what AI, quote unquote AI will do for us in the future. And I'm anticipating it's going to lead to some significant changes for us in asset management, wealth management, research functions in the future. but technology's consistently been allowing our industry to evolve, just as it has for a lot of other industries. Today, just about any data or third-party insight is at our fingertips. And that hasn't always been the case. Not that long ago, you really had to have boots on the ground in order to identify relationships, find information that was more than just surface level in order to build those relationships and discover information about companies or investments that were opportunities that you had to do due diligence on. I think the problem with digitization, availability of data, and such is that it's actually reversed now from where it was years ago. We have access to so much information. It's a question of how do we filter through it to find what's beneficial, what can we trust, what's additive to our investment processes, and allows us to enhance returns we're delivering to our stakeholders. What tools do we use to process that information and data more efficiently and surface relevant information on a timely basis? And the nice thing about it is that the tool sets have also expanded, and the service providers in the marketplace often start as pieces of entities that might be just a single asset manager, and then they go out and they spin out and they form their own business, helping firms to process information, to retrieve data, access it, and process it into their investment processes on an efficient basis. So that's how I see things benefiting. But I think we're going to see a lot of evolution over the course of the next several years.
Yeah, I mean it's exceptionally interesting because a lot of the digitization is still happening. If you look at how difficult it has been for see even the mighty Bloomberg to get a lot of good data on bonds, particularly municipal bonds. That's still coming along. People think of it as like something that happened in the 90s. It didn't. It's still happening. So it's also but it does, as you say rightly, add to the more data doesn't mean you have higher quality data. Data just means you have more. So yeah, it's real tricky. So let's dig into that a little bit. Where do you think things are going to go on the use of more quant techniques, large language models, et cetera? Take a swing at that. What do you think is, how is that changing the job that you do?
It's interesting. I think about it from the perspective of investing right now, and I think where a lot of us in the business are focused on where we're making our investments is in the kind of infrastructural elements. So, the chip makers.
Yep.
It's like everybody's going to have to use those to benefit from AI and large language models and so forth. The solution side, I think there's a lot of hype on, there's a lot of speculation on, but that's going to evolve over the course of the next several years. The biggest problem, I think, for our business right now, for our industry, and many others, is data quality.
Yep.
Having access to our own proprietary data to be manipulated by these new tool sets, by the chat GPTs of the world, by large language models. And there's a lot of, massive sensitivity about the security of that data,
Yep.
because we
Yep.
need to use our own private data within these large language models. You've probably done some of your own testing on it. If you go out and you try to do any kind of financial services related things with just testing on ChatGPT, you find a lot of holes in the data quality.
Yeah, I'll
And
say.
so if we can take the tools and hook it up with our own data, I think the reliability factor is going to go up dramatically. So we got to deal with the security issue. Once we do have a connection, there are a host of potential solutions that are being targeted. I think the early things are going to be efficiency based, maybe some more mundane tasks that are leveraged by AI. Let's say like writing a commentary on a regular basis for stakeholders,
Yep.
that's going to pull in reliable, accurate, private data, and it could be very client specific. Here's how your portfolio performed during the last period relative to relevant benchmarks, and perhaps even your stated client goals. And it could be very efficient to produce those. I think right now, I mean, maybe it'll go away over time, but right now it's really important that anything we do like that's going to eventually touch a client or other stakeholders, there needs to be a set of human eyes on to make sure that these things are coming up with accurate output that is going to be witnessed by our clients.
Yeah, but those types of tools can basically give the analyst or whoever's doing the work a bit of a running start at the task.
Absolutely.
Yeah.
Absolutely. And
Yeah.
that makes it a lot more efficient.
I thought it was
The hype
interesting.
part of it's kind of scary is that from our side of the equation, where we're examining particular sub-advisors, we see this change in how people are positioning themselves. Managers that 5, 10 years ago were quant shops and kind of were quantitative techniques, were systematic investors. They're now all AI investing pioneers. And
Right.
so, you get a little bit hyperbole of people want to be associated with the next big thing. So you have to weed through some of that in order to find out, okay, what are you really talking about? But we have added in our due diligence questionnaires, officially getting into specific questions about, okay, what is your concept of the role AI will play within your organization, with your investment processes? What research you're doing right now? Is there any application that is already in place that is impacting your process on a day-to-day basis? Those are the kind of questions we're asking.
Yeah, I mean, I think you sort of talked around there. One of the things that I think is also very interesting about this is about AI and LLM is you have to know how the model was trained. And that is very difficult for even the person who trained the model to explain in a way that you can say, okay, this causes the following variabilities in the data I'm analyzing with it. It's that's a whole other thing we have to cross that the royally has to cross to get this to a place where, as you say, it can go to the client, right? Because we're still
A lot of iterative testing in front of us.
yeah, it's going to be a whole thing now. So one of the things that I've really enjoyed speaking with you about over time is you have a particularly eloquent way of talking about conventional wisdom in finance. And we had a blast talking about this. I think people will enjoy enjoy this too. So uh, when do you think conventional wisdom can be really helpful too, right? It can be like, okay, people shouldn't smoke. Right? Conventional wisdom is people shouldn't smoke, and that's real good. People shouldn't drive drunk. Okay, that's that's now conventional wisdom. Um, but it's a hindrance that we talked about in a little bit and about asset allocation and investment management returns analysis. So, you know, which is your favorite of to take a try at?
Yeah, I mean, I'll give you a few examples. I mean, I do think it's always important to look back over time and challenge the way that we're thinking. But we have a tendency in this business to try to boil down complex issues into simple colloquialisms, to get out of the technical and into the informal. It's natural, right? Because as much as you and I can talk, most of our stakeholders and audiences probably have, like my wife, have little interest in what we do on a day-to-day basis. And they don't have the technical knowledge to really process the details. So the problem occurs when the colloquial message diverges from what the research actually had uncovered. So I give you the first example I give you is like the efficient market hypothesis. And I see it as important seminal research examining the process of information being absorbed into the market and reflected in prices. In this day and age, I don't know how many people could disagree with that, right? I mean, maybe 50 years ago, it's kind of like, well, I don't know. It takes a while for this to sprinkle out through the marketplace, but I don't know many that would dispute that public information is instantaneously reflected in prices and maybe even private information. But how did that get convoluted into efficient markets mean active managers can't outperform? Processing information instantly doesn't equate to processing it perfectly. And candidly, I don't even know what that would mean to process it perfectly. But really, if you think about it, the market's just the aggregate of us investors. And there's quantitative decision-making investors. There's a collection of human investors as well. So an investment's price is really just the aggregate reflection of how all of us processed all the available information to settle on what we think the investment is worth. So I get the arguments of the wisdom of herds proponents, but averaging the imperfect insight of all investors doesn't magically lead to some perfect price that eliminates the potential for alpha.
Right.
So that's the first thing I would think about. It's like, okay, we've taken some good research that is important, and then we've kind of skewed it into supporting something that I don't think that the research actually proved.
Yeah. Yeah. The other thing that I think is exceptionally interesting about this is talking about in terms of asset allocation. So what role does asset allocation have in determining returns? 90, 60,
Yeah, right.
50%? What is that?
93.6% was what the Brinson B. Bauer Hood study said back in the 70s.
Yeah.
And that, but you think about what that was from. That was 91 public pension plans that were
Right.
evaluated.
Which is all there
So you're
were
talking
then. That
about a
was
very,
before ERISA, right?
that's a very homogeneous group. They invest very similarly, highly diversified, but what came out of that research was then people said, oh, hey, look, 93.6%. That means nothing else matters. It doesn't matter what stocks you pick because asset allocation is going to drive all of your performance. So don't be worried about picking stocks because it won't make any difference. Uh, the findings were not only mischaracterized, they also ignore the fact that the subject investment schemes were homogenous, using similar asset class, having similar objectives. And if you look at, I think Roger Ibbotson did a follow-up on it, and his research looked at the fact that there could be differences in the way people actually apply their exposure to asset classes, and so if you had something that was much more concentrated in exposures to asset classes, much different than what the public pension plans were doing, I think his results were, the impact of asset allocation might be somewhere from 90% to 40% to 10%. So it really was a kind of it depends kind of answer again,
Yeah,
right?
that means also the 10 to 90% means we don't know. So,
We don't know.
yeah,
We don't know, right?
yeah.
So
Yeah, yeah, I know I'm not a statistics expert, but I know a little bit. So,
yeah, I'll give you another one. I think it's an interesting one because I hear zero sum game,
yeah,
just
right,
all the time within this business. Candidly, I think it's one of the underpinnings of why the extrapolation of the efficient market hypothesis to active management can't outperform. It's related to that, but the basic underpinning from the proponents of the zero sum game, canceling out the ability for active managers to outperform in aggregate, is that every trade is a winner and a loser. So if
right,
one active manager is a winner, the other active manager in the trade must lose.
right,
But the first problem with that is that active managers aren't the only market participants. So
right.
what's happening when a high yield ETF, high yield index ETF is dumping shares because there's more supply than there is demand. And active managers are stepping in mass and are acting as a source of liquidity. They're actually providing the demand to let the market clear. Uh, Generally speaking, couldn't the active managers be winners and passive losers in a situation like
Sure,
that?
right.
Then also there's a third plane in this. The third plane is time that
Yes.
gets ignored completely by people that bring this up. I've had this argument with some of the people that, are proponents on the other side of this, but if one investor is a high frequency trader with a millisecond time horizon and the other is a wealth planner planning for a client with a 20-year horizon, why can't both be winners,
Right.
or both be losers for that matter? Because it's become so ingrained in financial media and our industry's collective thinking that I don't think many people ponder what the assumptions are and whether they make any sense. It's just mindlessly trotted out over and over again. So why not apply it to active management? It's a zero sum game. Case
I,
closed, right?
yeah, it's a funny old thing. I mean, I do think that part of the appeal to it is it's simple, right?
Yeah,
I
that's right.
one of the as a what I refer to as a mocha, a man of a certain age, the simplicity every year seems to decline. My perception of simplicity declines. My respect for the concept of losers and winners is lower all the time because sometimes the winner gets nothing. So it's
Right.
yeah, nuance is hard to avoid. One of the other things that we talked about that I like to kind of end on is could have a massive impact on investing, due diligence, et cetera, even liquidity in the markets. And that's what we were talking about, uh, the long-term equilibrium, so to speak, and the inherent need to keep rates low. And we were talking about this in terms of sovereign debt, mainly the U.S.
Yeah, it gets a little bit ethereal. Maybe it's more just this is my personal opinion, but it all comes down, I think, to what is normalization, right? Because we learn from our experiences over the course of time. So, heck, I was around, kind of back in the 80s when rates were at massive high levels. Inflation was a battle that people thought was going to rear its head over and over and over again over time. Even at that time, you couldn't imagine that we're going to go through, a 30 plus year period where rates were just on a downward trend. And now we get to a point where over the course of the past decade, rates were really low. And so even the Fed back just after the crisis, if you looked at their dot plot back then, they would talk about the normalization of, well, over the course of the next 3 or 4 years, rates are going to go back up and they're going to get to normalized levels of 3 to 4%.
Right.
Well, the lesson we have to kind of learn from it is kind of like, okay, we can't be thinking about normalization of kind of what existed 10 years ago or 20 years ago on average is going to necessarily come to pass again. And I don't know, the cynical part of me kind of looks at it and says, post crisis, you went through a period where there's a lot of intense increase in government debt loads, and some of that is part of bailouts, some of it is parts of firms kicking the can down the road for entitlements and other obligations. And so now you get a very heavily indebted globe. And so there's a selfish reason why governments, would like rates to be low, because they got massive debt services if they aren't low. And so the question becomes, how will, the government entities kind of try to engineer situations that are better, for, they would say, I would think, or, they could argue that it's better for their societies because with lower rates, they can afford to fund more things instead of fund more debt service, right?
Right. But
So that's the cynical part of it.
yeah.
Eventually you get to a tipping point, right?
Mm.
But the question is kind of like, okay, when did the demand side of the equation dry up, right? And that's a big battle that we all have in our heads right now. It's kind of like, okay, well, when does demand for treasuries dry up such that you can't even float a treasury issue anymore because
Right.
there's not enough demand unless you significantly increase rates? But I don't think anybody anticipated the amount of increase in debt throughout the globe over the past 15 years that was sustainable in the way that it has been so far. So,
Yeah, yeah. I mean, like it's a very interesting thing, but I think one of the things you talked around there that I also think is really interesting is that it's hard to tell when something we know is going to happen will happen. So, you take the UK, a place I love dearly, but had exceptionally low growth and relatively high expense increases for about a decade before they had a prime minister come in and talk about trickle down economics, and then the bond market went to town. Why then? We've known this for years. Why then?
yeah,
So,
you can compare it to kind of like, I mean, people talk about perma bears that are always on the media, and they're in short supply, so the media will bring them in for the other side of the equation. And as long as they're consistent, they'll eventually be right.
exactly.
And then they'll write a book about it, and that's where they'll make all their money. Right.
Right. Yes. Yeah, the clock stop book strategy.
Exactly. Yeah.
All right, well, so perhaps we'll leave it there, but thank you again, Tim. This has been a really wide-ranging conversation, but something I think is very valuable to the people who are listening to this podcast. So thank you.
Yeah. Great to be with you again, Rob.
And thank you to those of you who downloaded the podcast and listened to it. Once again, this has been Compound Insights. We'll be back in another week, and I'm your host, Rob Rowan.